For decades, China's economy soared, transforming the country from a largely rural society into a global manufacturing powerhouse. Towering skylines and sprawling industrial zones became symbols of China's rapid ascent. This growth was powered by a relentless focus on exports, especially to the United States, which became China's largest trading partner and a crucial source of demand for its goods. But that partnership fractured when the US slapped steep tariffs on Chinese goods, sparking a trade war that upended global commerce and sent shockwaves through supply chains worldwide. Tariffs as high as 145% on Chinese imports and 125% on US goods brought trade to a near standstill, leaving ports and warehouses eerily quiet. Even after a truce, tariffs remain high, around 40%, making Chinese products less competitive in America and squeezing profit margins for exporters. US companies began sourcing from Mexico, Vietnam, and India, draining orders from Chinese factories and accelerating a shift in global manufacturing. This de-sinification of supply chains has fundamentally challenged China's export-driven model, forcing companies to adapt or close their doors. Factories that once thrived on US demand now face empty order books, with production lines sitting idle and workers sent home. The certainty that lifted millions out of poverty is gone, replaced by anxiety and uncertainty for families and business owners alike. Chinese leaders can no longer rely on the US as their economic engine, and must now search for new sources of growth and stability. They're forced to rethink their entire strategy, just as other domestic crises, like youth unemployment and a struggling property market, emerge to complicate recovery. The perfect storm is here, and China's economic foundation is cracking, leaving the world to wonder what comes next for the once unstoppable giant. The tariff war's impact hit China's factories fast. Once busy production lines slowed, and machines sat idle. By August 2025, industrial output growth dropped to its weakest since the pandemic. Exports to the US plunged over 33% year-on-year, a collapse not a dip. Factory owners faced canceled contracts and layoffs. Unemployment climbed, especially among migrant workers who lost their path to the middle class. Young people were hit hardest. Youth unemployment soared past 20%, so high the government stopped reporting it. Many graduates, unable to find work, adopted a lying flat mindset, doing the bare minimum. This signals a deep loss of confidence in the future. The slowdown isn't just economic, it's social, threatening China's stability. The once reliable engine of growth is sputtering. The silence on the factory floor echoes across the nation. As trade faltered, China's property market, once a pillar of growth, began to collapse. Real estate made up nearly 30% of the economy, with families investing life savings in homes, but prices fell 20–30% from their peak, erasing household wealth and confidence. Developers like Evergrande defaulted, construction halted, and ghost cities multiplied. An estimated 60–70 million apartments now sit empty, enough to house France. Smaller cities face a decade or more of oversupply and stagnation. The property boom has turned into a national nightmare of debt and distrust. The dream of home ownership is now a burden. The real estate crisis has left a legacy of empty buildings and broken promises. China's economic engine has lost another vital cylinder. Beyond trade and real estate, China faces a deeper, more profound crisis: demographics. While headlines often focus on economic slowdowns or property bubbles, the real challenge is quietly unfolding in the background: a rapidly aging society and a shrinking population. The population peaked in 2022 and is now on a steady decline, with projections suggesting China could lose as many as 140 million people by 2050. This is a dramatic reversal for a country that once worried about having too many people. The birth rate has collapsed to just 1 child per woman, far below the replacement level needed to sustain the population. Fewer children are being born each year, and many schools and kindergartens are closing their doors. The legacy of the one-child policy, combined with soaring living costs and shifting social values, means fewer marriages and even fewer births. Young people are delaying or foregoing marriage altogether, and the traditional family structure is changing. As a result, the workforce is shrinking rapidly, driving up labor costs and threatening China's long-held status as the world's factory. Factories struggle to find young workers, and some are forced to automate or relocate. An aging population puts immense pressure on pensions and healthcare systems, creating a looming funding crisis. Hospitals and clinics are already feeling the strain, and the burden will only grow heavier. Unlike Japan or Germany, China is aging before it's rich, making the challenge even harder to overcome. Many elderly people must keep working well past retirement age just to get by. Economists warn that demographics alone could shave half a percentage point off annual growth, slowing the country's economic momentum and making it harder to achieve prosperity. The government faces a difficult dilemma: how to care for a rapidly growing elderly population without the wealth and resources of a fully developed nation. Social safety nets are being stretched thin. The demographic time bomb is ticking, and every year the challenge grows more urgent. It's a slow-motion crisis that will shape China's destiny for decades to come, affecting everything from economic growth to social stability. The country risks growing old before it grows prosperous, with millions of seniors facing uncertain futures and young people shouldering ever greater burdens. The future workforce is shrinking, and so are the hopes for easy growth. For China, the path ahead is uncertain, and the stakes could not be higher. Beijing has unleashed massive stimulus, slashing interest rates, injecting cash, and ramping up government spending. Infrastructure projects and consumer loan subsidies aim to jumpstart growth, but confidence is missing. After years of uncertainty, people are saving, not spending. Consumer spending remains stuck at just 40% of GDP, far below developed countries. Official growth numbers look solid, but much of it is state-driven, not fueled by private demand. The government's efforts are like pushing on a string. Cheap credit can't force people to spend if they're worried about jobs or home values. Without a revival in confidence, stimulus only papers over deeper cracks. The real challenge is restoring trust in the future. Until then, China's recovery will remain fragile. The government's toolbox is full, but the real problem is psychological. China's economic slowdown is sending shockwaves across the globe, touching nearly every corner of the world economy. Once the engine of global growth, China's struggles now ripple outward, affecting countries, companies, and consumers everywhere. Resource exporters like Australia and Brazil are feeling the pinch as China's appetite for raw materials, like iron ore, coal, and copper, shrinks. These nations, heavily reliant on Chinese demand, now face falling prices and uncertain futures for their mining sectors. The trade war and pandemic have accelerated a global supply chain shift. Companies are no longer putting all their eggs in one basket. The China Plus One strategy is gaining momentum, with firms investing in Vietnam, India, and Mexico to diversify production and reduce risk. This rewiring of manufacturing and trade routes is reshaping the global economy, creating new winners and losers as supply chains adapt to a changing world. Meanwhile, wealthy Chinese are moving money abroad, especially to the US, in search of safety and stability. This capital flight boosts demand for American assets, strengthens the dollar, and impacts real estate markets in cities like New York and Los Angeles. China's deflationary pressures mean cheap goods are flooding global markets. While this benefits consumers with lower prices, it puts intense pressure on manufacturers in other countries who struggle to compete with China's low costs. As consumers snap up bargains, local industries in many countries face falling prices, weak demand, and even closures, threatening jobs and economic stability. China's crisis is both a challenge and an opportunity for the world. Policymakers and business leaders are rethinking strategies, debating how to adapt to a less predictable global landscape. America's reputation as a financial safe haven is reinforced, attracting global capital even as worldwide growth slows and uncertainty rises. The world is learning just how deeply it depends on China's fortunes and how interconnected our economies have become. In today's globalized world, China's pain is everyone's problem, and its recovery, or continued struggles, will shape the future for us all. Despite the gloom, China's economy isn't a wasteland. The tech sector remains vibrant, with advances in AI, electric vehicles, and renewables. Inland cities like Chengdu and Wuhan are growing, driven by domestic consumption. Retail sales in these regions outpace the national average, hinting at economic rebalancing. Stock markets in Shanghai and Shenzhen have shown resilience, buoyed by government support and investor optimism. These bright spots show China's capacity for adaptation and innovation. But they're not enough to offset the drag from real estate and exports. The structural problems, debt, demographics, weak confidence, are vast. The flickers of hope are real, but the storm clouds are bigger. China's future depends on whether these sparks can ignite a broader recovery. Is China's economy collapsing? Not exactly. The government still has powerful tools, and parts of the economy remain strong. But the old growth model, exports, construction, property, is broken. China faces a deep structural crisis, not a temporary slump. The challenge is to shift toward domestic consumption and innovation. This requires painful reforms, letting failed firms go under, tackling local debt and building a real safety net. So far, Beijing has favored stability over tough choices. If reforms stall, China risks a lost decade of stagnation like Japan after its bubble burst. Demographics make the task even harder. The era of miracle growth is over. Now comes the hard work of correction. The world is watching. China's next move will shape the global economy for years to come.